Hi everyone, welcome to a brand new episode. I'm Marcus and today we're looking at Cisco Systems, ticker symbol CSCO. We'll cover the income statement, balance sheet, cash flow, key figures, our key feature, and the technical aspect of the stock. Now, should we consider Cisco? Well, let's find out. So Cisco System is traded on NASDAQ and are in the technology sector. If we go down to the company description, we can see that they are an American multinational technology conglomerate headquartered in San Jose, California. And they develops, manufactures, and sells networking, hardware, software, telecommunications equipment, and other high technology services and products through its numerous acquired subsidiaries such as OpenDNX, WebEx, Jabber, Jasper. And Cisco specializes in specific tech markets such as the Internet of Things, domain security, and energy management. And we can see that their market capitalization coming in at $216 billion and a revenue of $54.9 billion. Now, they have an attractive PE ratio of 18. Normally, when you see a stock with a high PE ratio, that tells you that the market expectation of the stock is high, and therefore there are a good chance that you see capital gains on those stocks because the market expectation is high and the investors are pushing the price even higher. But the overhanging risk is if the company cannot meet those expectations, we will see the stock price decline. Same thing goes whenever you see a stock with low PE ratio, that tells you that there are not a lot of investors looking at it and not a lot of expectations, and therefore you might not see capital gains on those stocks. But having a PE ratio of 18, that is good. They have also a good profit margin of 20%. Now, the price to sales ratio and the price to book value coming in a bit too high, making the company a bit overvalued. If you are a dividend investor, this is great news because they do pay a dividend of $1.53 and have an effective range between effective return of 2.9%. I like companies that have effective return between 3 and 6%, but at the same time, I don't just jump the gun whenever I see a stock with high effective return because that could be a trap. I like to take a step back and look at the overhanging picture. Is the company declining? Is it consolidating? Or is it actually expanding? Because you get good returns as long as you hold the stock. But whenever it comes times for you to exit the stock, you might not get a higher price than what you actually paid for it. So it is important to have an exit strategy and also have a clear understanding of why am I pursuing this stock. Return on equity, I need to report these numbers, but I believe it's around 27%. That is good. Basically, it tells you about a company's ability to create return on their equity. And return on assets is coming in at 9.5%. That is also good. It tells you about how efficient the company utilizes their assets in order to create profits. Now, if you look at the stock price, it's currently traded at $53 per share. If we go down, we can see that it's above both the 50 and the 200-day moving average, indicating that we might see the stock price increase. If you take a look at the chart, we can see that we have been moving within a positive trend channel for quite some time. But we'll take a closer look at the technical aspect further down. But let's head over to the income statement. So on the income statement, what we're looking at here is that the total revenue, you can see, went from $4.9 billion up to $51.4 billion. And we can also see here, if we click on it, we can see also the development over the years. And we can see it's not a huge change. Went from 49 up to 54. And we can see here the change year over year in percentage. In 2019, they improved their revenues by 3.4%, and then in 2020 it fell back down to with the negative 3.9%. If we look at the net income, we can see went from I think this must be $11 billion and went from up to $11.8 billion. You can also see here the change in not much, but it is moving within a positive direction, so that is a plus. Now let's head over to the balance sheet. What we're interested in here is that the current assets versus the current liabilities, and we can see there's a huge difference between the current assets and the current liabilities, basically telling you that if the company were to convert these assets to cash, they're able to pay off their current liabilities, but they are far from being able to pay off the total liabilities. That is negative. But at the same time, there's not a lot of companies that are able to actually pay off the total liabilities. There are some, but there is not a lot of them. Now, if you look at the total liabilities, we can see here is that it went from $65 billion down to $54.2 billion. We can see that it has been dropping year over year, and that is just amazing. I like the fact that they are reducing the total liabilities. Number of outstanding shares went from 4.9 billion shares down to $4.1 billion. And these numbers have been dropping, so that is a plus. Basically, what is happening here is that the company are doing buybacks, meaning that they're buying back their stocks, and therefore making your share of the company increase because there are fewer and fewer available shares out there. Whenever you see a company, whenever you see these numbers increase, that means that the company are issuing more and more shares. There are more and more shares out there, making your share of the company decrease, meaning that you're being diluted as investor. And there's a lot of people that either skip this part or doesn't know about it, because they'll be looking at a balance sheet and see that this company has a strong balance sheet, so therefore this must be good. But at the same time, a company are issuing more shares, and that's a way for a company to bring in more capital without taking on more debt. So keep that in mind. Now, if we go over to the cash flow, what we're interested here is that the operating cash flow and the capital expenditure, we can see here it went from 13.7 billion down to a $13.2 billion, and they need to find ways to become more efficient and more profitable. And we can see that the capital expenditure went from 834 million down to 477 million. So this is negative. But for a company this large, they need to continue to invest in the business. I would like to see capital expenditure actually increase for them to find more revenue streams and increase their profit, improve their efficient operating margins in order to generate more profit. So I would like to see them continue to invest in the business, but at the same time also operating cash flow need to find ways to become more efficient. Now let's go over to the key figures. What we can see is that the earnings per share went from 2 cents up to $2.84. These numbers increased but fell off a bit, but recovered in 2022. Overall development is plus. Revenue per share went from $10 up to $12.5. And we can also see same trend here. We fell off and then recovered the last 2 years. So that is a plus. Equity per share went from $8.85 up to $9.68. And we can see how we fell off, recovered, and have been grown and fell off a bit. But overall trend is positive. That is a plus. Dividend per share went from $1.23 up to $1.51. And these numbers have been improving year by year. So that is a plus. But at the same time, if we take a look, we can see here is that even though the dividend per share have been increasing year by year, the change in which it has increased is not much. In 2019, they grew their dividends by 14.6%, which is a lot. But have since seen a lower numbers. We have 0.7%, 2.8%, and here 3.4%. So even though we are seeing that these numbers are increasing, it's not increasing that much. Dividend share went from this, I believe, is 54.5%, but so it has been ranging here, 53, 58, 52. I like this one because I like company that pays out less than 60% of their capital, because I want some of the capital to remain in the business for acquisitions, investment, or just overall strengthen their finances. So this is a plus. I like that. Gross margin went from 62% up to 62.7%, but here, as we can tell, not a lot of fluctuations. Sure, this is great numbers. It is a lot, but at the same time, you would like to see a clear direction that they are actually becoming more and more efficient. They are reducing their cost of goods sold. But overall, this is great numbers, but I would like to see a more stable development, but still a plus. I like that. Operating margin went from 24.9% up to 27%, so that is a good, but same thing as we're all seeing that it's a small fluctuation. It is moving in a positive direction though. Profit margin is 0.22% up to 22.9%. Here we can see that it is getting better and better, so that is a plus. Return on equity is 0.25% up to 29.7%. It grew here, fell off a couple of years, and then recovered in 2022. Overall trend is positive. Return on assets went from 0.10 up to 12.5%, and these numbers have been improving year by year. But this is positive. I like that. Let's go down to the solidity, and we can see here it went from 39% up to 42%. Basically, what solidity is, it tells you about a company's financial strength for the long term. And seeing that we went from 39% up to 42%, that is a plus. Balance sheet liquidity, same thing as solidity, but here it looks at the company's financial strength for the short term. Here we went from 1.6 down to 1.25, so this is negative. Debt ratio went from 1.52 down to 1.36, so this is a positive. Basically, what it's telling you is that in 2022, the company had 1.3 times more debt than equity, and seeing that these numbers are dropping, that is a great thing. Now, guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to our key features, which is our stock analysis. What it does is that it basically summarizes everything we've gone through in an easy, digestible manner. So it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. We can, for instance, see that Cisco gets a score of 49. Which is just in the middle of being weak and a strong company. And we can also see that their valuation, the stock price is at $43. We can see that it is a fair value, which is between $34 and $63 per share. And the price development, we can see that they are actually indicating that we might see the stock price increase. If we take a look at the chart marks, we can see here right away that the PE ratio is below 20 or equal to 20, which is a plus. The price to sales ratio and price to book value a bit too high, and we can see here that they do pay a dividend, which is a plus, and the dividend payout share is less than 60%. The number of dividends increased over the past 5 years, and the number of outstanding shares have decreased. And we can see that the revenue increased of the past 5 years, profit margin above 15%, profit increased over the past 5 years. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. You can have this tool with everything we've gone through, plus access to our YouTube channel, discussion forums, and everything for only $10 per month. So make sure to head over to finvy.io to support the channel, okay? Well, now let's take a look at the technical aspect of the stock. So here we have the chart. Let me just lay down some lines here. We can see, for instance, that we have a line somewhere around here. We have the support line. We also have one somewhere right here. We have another one somewhere around here. Okay, so the stock is currently at $53 per share. As you guys can clearly see that we are moving within a positive trend channel. I have been doing so for quite some time. But as you can see, we are also closing in on the resistance level around here. So basically, what we could see is that the stock price continue to increase, hit the resistance level before moving towards the support line further down, maybe around this pad around here. So, okay, so what would I be doing as an investor? For me specifically, this is a great and stable company, which has been around for many years, and I believe will be around for many years. They have had good operations. And I believe if I were to buy the stock, I would look for increasing my safety of margin, meaning that I would be looking for the stock price, see if it hits this resistance level. If the stock price doesn't break and start moving towards the support line, but that would be a buying opportunity for me. But this is a type of company that would be holding for many years to come and just earn those dividends, and also have a potential capital gain on those stocks. But as you guys can tell, we are clearly close to the resistance level here around $56 $57. If we were to break this channel, we can see that we have another resistance level here at $60 and another one at $63 per share. So it's not a huge capital gains. We're talking about maybe 12-15%. So that is not a huge move. But at the same time, this is a stable company would hold for many years to come. But everything below this line here, it's definitely a buying opportunity. So that's what I'll be looking for. I'll be very patient and wait for the stock price to hit the resistance level before coming back down and improving my margin of safety before entering the stock. How would you trade the stock, or how would you invest in the company? Please let me know in the comment sections below, and I hope you have enjoyed this episode. If you have any stocks you want me to take a look at, please leave them in the comment section below. Thank you so much for watching, and make sure to like and subscribe. Until next time, take care, guys. Bye-bye.